market. According to what I'd regard as the best available index, housing prices are up 9% over the last year. Normally, demography leads to about 1.5 million new houses for new families each year. We have been running for many years now well below 1 million. In fact, if you look at any reasonable estimate of all the extra houses that were built during the bubble, and then you look at how far short of normal we fell between 2008 and through 2012, the shortfall is twice as large as the excess. And so the pressure for more building is coming. You see it in the neighborhood where I live. For the first time in a decade, people rushing to bid against each other and bidding prices up above asking prices for residential houses. You're seeing a turn in housing prices. Employment growth at 200,000 plus means stronger growth in disposable income, which means stronger consumer spending as well. There is substantial investment opportunity in the United States in the energy sector especially. Tight oil, something that was not on the landscape just a few years ago, will be absorbing 0.5 to 0.75% of GDP just in direct physical investments each year for the next few. Energy prices, which while hardly low, now look for the remainder of this year to be a good deal lower than people expected 6 months ago, will be a further impulse to consumer spending. And so my expectation, supported by the creation of $2 trillion plus in wealth in the stock market over the last year, and another $1 trillion in the housing market, would be for recovery to accelerate to the point where growth this year is in the 2 to 2.5% range, rising above 3% next year and in 2015. Now, to be sure, there are important things to worry about. Perhaps most salient in any financial group is the concern that this prosperity and strength is built on a foundation of paper. Paper bonds, paper money, quantitative easing, something other than real and concrete economic strength. And those fears cannot be discounted. Yet, consider this. On the current forecast, with no further actions, debt will, for the next 6 years, fall relative to the United States' GDP. Healthcare costs, which account for almost 1/4 of our budget and have been out of control for decades, actually appear for the last 3 years to have grown no more rapidly than GDP. And the statisticians know what has not been publicized widely yet, which is in the period surrounding this April 15th, we collected about $100 billion more in revenue than had been anticipated, pointing to the possibility of deficits that are less serious than is supposed. Monetary policy confronts, to be sure, important challenges. It is easier to enter into quantitative easing than it is to exit from quantitative easing. Long-term rates remain at abnormally low levels. And yet, if you look at signs of U.S. inflation pressure, wage growth is actually down. Break-even inflation, as inferred from our index bond market, shows declines. And there is time to address these concerns. And so there is a risk of slowdown, to be sure. There is a risk that the exit will not be simple to manage, to be sure. But I think the preponderant expectation has to be for relatively rapid growth that remains stable for some years to come. I do not minimize the various political challenges in the United States, and there have certainly been moments in the last couple of years of squabbling over the budget deficit that do not seem to me to befit a great nation. Yet, for all our problems, we come with substantial strengths in the United States that I will believe will serve us well in the years ahead. 4 stand out. A basic resilience. It is perhaps a feature of the United States that we have this capacity to become tremendously alarmed about our future. And that then spurs us to action. I am old enough to remember the Sputnik period, when people thought that the Soviet Union would surpass us. John Kennedy believed on the day he died that the Russian economy would be larger than the American economy in 1985. I remember well as a young economist reading the Harvard Business Review in 1991, every single issue of which had some version of the joke that the Cold War was over and Japan had won. And we were alarmed. And we're alarmed again. And that's what puts in motion the processes of change that respond to the alarm. Energy. I already touched on it. I was studying on the plane here a Citigroup analysis. I don't know whether the analysis is precisely correct or not, but the fact that it could be made is a very powerful statement. It said that by 2020, the combination of U.S. oil imports, U.S. domestic oil production, and U.S. imports from Canada will exceed U.S. domestic consumption. That is a profound change that points to a substantial improvement in our trade position and points to a substantial source of strength. And of course, for more years, U.S. manufacturers and U.S. energy users will benefit from a price of natural gas that is far below the price of natural gas in other parts of the world. Innovation. If you think about where those products are coming from, where those mobile phones are coming from, so far, others have not been successful in emulating the distinctive combination of flexible, incredibly entrepreneurial finance and an entrepreneurial culture that defines Silicon Valley and information technology, or my home city